This is the Fun and Sexy Finance Show, where we talk about all things money, so that you can learn how to make your money work hard for you instead of you working hard for your money. Hi, I'm Susie Fabrocini, and I want to welcome you to the Fun and Sexy Finance Show. Today, we're going to talk about 1031 exchanges. What's a 1031 exchange? Well, it's when you exchange one investment property for another investment property. So if you were to sell an investment property, normally you're going to have to pay capital gains tax on your gain, which would be the difference between what you purchased the property for and what you sold the property for. That's your gain. So that would normally cause a taxable event. You would need to pay taxes on that gain. Now, it's really important to understand how to use 1031s because this is a great investment vehicle. I know they keep talking about getting rid of it, but it's still here, and while it is, let's make use of it. You really want to take advantage of this because what it does is it allows you that money that you would have paid in taxes, you can now roll it over into your next purchase. So it helps you to grow your investments faster. So instead of paying taxes on that gain from the sale of property A, you are going to use it towards the purchase of property B. And of course, because it is a financial transaction, there are rules. Always there's money rules. So here's the money rules for this. Number one, there are time frames. And these are really important because if you don't meet the time deadlines, the whole thing is blown and you're going to owe the taxes. So when you're going to do an exchange, from the day that you close on the sale of property A, you have 45 days to identify what the replacement property will be. So it's a good idea to identify more than one property just in case the first one you identify, if the sale doesn't go through for some reason. Because if you only identify one and the sale doesn't go through, then you're kind of screwed. So it's a good thing to identify more than one. And second rule is that from the date of the sale of the first property, you have 180 days to close the sale on the second property. So that's quite a bit of time. Hopefully you should be able to get it done. If you can identify it in 45 days, then you should be able to close in 180 days. And then there's another rule. Of course, the property that you are buying must be equal or more than property that you're selling. So equal or more value. It has to cost the same or more. And if you have a mortgage on the first property, your second property must have a mortgage of equal or greater value to the mortgage on the first property. If the numbers don't work out, any money that you end up keeping from, if you don't put all the money into the next properties, then that's called boot. Any money that you take from the transaction that you keep, that's boot, and you pay capital gains taxes on that. So if you don't want to pay any taxes, you roll over all the money. If you need to hold on to some of that money, no big deal, not a crime. You just know that you're going to have to pay taxes on it. More rules. Let's see. Oh, they have to be like kind. And if your property is in a trust or in an LLC, that trust or LLC that sold the property also must be the buyer on the other end when you buy the replacement property. So there's the 45-day rule to identify. There's the 180-day rule to close. There's the equal to or greater than value on the purchase and on the mortgage of the replacement property. There's the rule about the entity that is selling the property must be the entity that's buying the property on the other side of the deal. And you pay taxes on any boot that you keep for yourself, which is not a big deal. Just know that it's going to happen. And you can use more than one, you can purchase more than one property. It doesn't have to be one property for one property. So for example, the first time I did a 1031 exchange, I was selling a property. It was a townhouse in Los Angeles that I bought for $150,000. And during that big real estate bubble in 2006, 2007, my property was worth over $500,000. So we sold that townhouse for $535,000. Now, if we weren't doing an exchange, we would have had to pay taxes on that difference between the 150 and the 535. That would have been quite a lot of taxes. So we did the exchange. We didn't have to pay the taxes right then. We were deferring them. I was buying properties in Texas to replace the California property, and the properties in Texas were a lot cheaper. So I needed to buy more than one property. So I actually bought a fourplex and 2 houses to replace that one townhouse. And still, they didn't add up quite to $535,000. So some of it did come back to me in boot. I had to pay some taxes on it, but it's okay. And that one was, I owned the townhouse in a land trust. So my land trust is what purchased the replacement properties in Texas. And then I took those 3 houses later and I sold them, and I did a 1031 exchange back to buying one house in California. The sale was through the trust, the purchase again through the same trust. There are some other rules that are involved. You can identify up to 3 properties.
Here's an example of the 3-property rule. Let's say you sold a rental property for $400,000. You would have 45 days from your sale date to identify up to 3 properties that you might want to buy. So here you see 3 properties identified in 3 different states at 3 different price points. Now you have 180 days from your sale date to complete your purchase of 1, 2, or all 3 of those previously identified properties. Now remember that the total value of the properties you purchase must be equal to or greater than the value of the property that you sold.
If you're going to be buying more than that, some people are doing like portfolios full of houses that they're selling and buying. If you identify more than 3 properties, the total value of the properties that you are buying cannot be more than 200% of the value of the property that you're selling.
So that's called the 200% rule. And you can identify any number of properties, but the sum of the values cannot be more than 200% of the sold price. So if you sold a property for $400,000, then the properties that you identify cannot add up to more than $800,000. You don't have to buy all of the properties that you identify, but you cannot purchase properties that are not on your identified list and have it be part of your 1031 exchange. So the great thing about this rule is that it gives you a little bit more leeway.
And you can't do 1031 exchanges with your primary residence. It has to be an investment property. But then again, with your primary residence, you get a great tax deduction anyway. You don't have to pay taxes on the first $250,000 of your gain on the sale of your personal property. And if you are a married couple filing your taxes jointly, then you get up to $500,000 free ride on your gain. When you come to the end of your 1031 exchange thread and decide you don't want to buy any more investment properties, you just want to cash out, just remember you're going to be paying your taxes on, you're going to be paying all those deferred taxes, plus they'll be adding back in all of the depreciation. I think I got it all covered. So we're going to take a break, and we'll be right back after this word from our sponsor. And we're back. And in this segment, we're going to talk about budgets. Oh, yeah, I know. Budgets is a word that sounds kind of like money diet, right? And diets are something that we associate with deprivation, with giving up something. And we're giving up something in order to lose something, right? Instead of thinking in terms of a diet, what if you thought about in terms of a eating plan to gain health rather than to lose something, you're gaining something. That's what I want to do with the word budget. Instead of thinking in terms of budget, which is like a money diet, a deprivation, a giving up of something, let's think in terms of a spending plan. So we're talking about a spending plan that will help us to reach our goals. In a previous episode, we talked about 3 money rules that help you to win the wealth game. Track your expenses, set up your accounts and automate them, and pay down your debt. The first one we mentioned, tracking your expenses, that's the most important one, because that's the one that will show you how and where you're spending your money. It's the first step in really taking charge of your money. The second reason that it's important is because it gives you the data that you need to set up your spending plan. It shows you how you actually spend your money so that you can build your spending plan around what is important to you, not what somebody else thinks should be important to you. Nobody should ever tell you that you can't buy a latte. Put it in your spending plan and buy the friggin' latte. So, the way that we set up our spending plan begins with keeping track of all of our income and all of our expenses for a month. We'll use this as the original guide. Of course, every month it's going to be a little bit different, so we'll be adjusting as we go. But we got to start somewhere, right? So start first month, keep track of your expenses, keep track of your income. Now at the top of your page, you're going to put down how much income you had come in that month and separate it. If you have different sources of income, I like to separate it so that I can see how much income is coming in from different sources and how much does it cost me to create that income, so that after a few months of doing this, you can look and see, are you spending your time and your focus in the right direction? So keep track of your income, and then we're going to list all of our expenses. I think it's a good idea to do it in alphabetical order. So list all of your expenses in alphabetical order, and your expenses are going to include your savings, your play money, your peace of mind fund, your donations, your short-term savings, and your long-term savings. You're also going to include all of your utilities, your rent or your mortgage payment, all of your bills, and then also include how much money do you spend on debt payments. So your credit card payments and other loans that you might have. You put your car loan separate. You might want to put your school loans separate. You may have several school loans. But list it all out. And then when you total all of your expenses and subtract that from the total of your income, it should come out to zero. If it doesn't come out to zero, then go readjust the numbers until it does. And then do that again the next month. So you get an idea of really what you're spending. So you have to know where you're starting from before you can really step in and decide how you're going to get to where you want to go. First we decide where we want to go. Then we look at where are we now? And then we look at how are we going to bridge that gap? How are we going to get from where we are to where we want to be? So previously, we spoke about setting up accounts at a credit union so that you can do automatic transfers. So you're going to put 10% of your income into a long-term savings account, 10% into a peace of mind fund, 10% into a play account, and now we're also going to add the short-term savings fund, 10%, and the donations, 10%. Another one to consider setting up would be for sharpening the saw or education. It's to increase your skill set in whatever field it is that you want to increase your skill set at. It could be something related to the work that you're doing, something related to the work that you would like to do, something to help you set up a business or to continue to run your business, or it could be something to do with a hobby that you have. Have separate accounts for each of these ones. That's why we said before, do it at a credit union where they don't have minimum amounts that you have to have in your account, and they're not charging you a monthly fee for your account. Then your money that comes in, you set it to automatically go out. Make sure as soon as the money comes into your account, the next day it's going out into your savings funds. You don't leave that till the end of the month to see how much money is left, because there's never anything left. Take the savings out at the beginning, and then what's left is the money that you have for living off of, okay?
Now, most people are going to have credit card bills as part of their spending plan. What I would like you to do is create a sort of a sub-chart, an extra chart for your credit card bills. Have one line for debt repayment on your spending plan. And then on a separate little mini chart, list out which credit cards you have, what you owe, what your minimum payment is, and how much your interest rate is. And then we're going to pay the same amount every month towards your credit card debt. What we're going to do is we're going to pay off one card at a time. So make the minimum payments on all of the cards except for one card that's going to get a little bit more than the minimum payment until it's paid off. And then you have more money to go towards the next card because you're still paying the same amount towards your debt every month. So what I usually like to do is pick the card with the smallest balance. Have that be your first one to pay off. Because if you do that, you're going to get the ball rolling quicker. You're going to have that extra money faster to pay down the next card. And then you can either go and say, okay, next highest to next highest to next highest, or if you pay off the lowest balance card, then start to look at them according to the interest rate and pay off your higher interest rate card next. And then keep going in that direction. You will end up paying off your cards much faster that way than if you paid a little bit more than what was due each month. Another thing, as you pay off each card, don't cancel it because that will lower your credit score. One of the things they look at, a couple of things they look at when you're getting your credit score, they're going to look at the average age of all your cards. So if you cancel one, that can change the age, the average age of your cards. And the other thing is that they're looking at how much debt you have compared to how much credit you have available. So
If you cancel a card, then you've just wiped out that much credit that you have available, and it's going to mess up your ratio and it's going to lower your credit score. I know it's kind of weird because you would think that if you have less cards, that that's a better thing, but it's not really. So just put the card in a sock drawer or just put the card separately somewhere so that you don't use it. Now, after you've got like 3 months under your belt showing your expenses and your income, you will have the data you need to get a feel for what does it really cost to do your life. And some of the luxury things should have been moved to the fun category so that you can save up money faster. And that's it for today's show. See you next time.